Hello, everyone, and welcome to today's event, Investing at Every Stage of Mine Development. Just as a reminder, this is being recorded and will be available to watch afterwards. Now, there was a surprise scheduling conflict, and Ian Bliss from Northern Shield Resources will be joining us, but he may just be entering a few minutes late. I've composed a few questions for today's event, but I want to remind everyone and encourage you to submit questions in the Q&A tab in the bottom right corner of your screen. We did allocate some time for Q&A, so please feel free to submit them in the bottom right corner. Welcome, gentlemen. I think we'll start off with introductions here. So could each of you just please introduce yourself and briefly share what stage your company currently is in? And Mark, we'll start with you.
Okay, yeah, I'm Mark Jarvis. I'm CEO of Giga Metals Corp. We have a giant deposit of nickel and cobalt and sulfides, low-grade, open-pittable, very similar conceptually to a copper porphyry type of deposit. You have to build a big mine, and in our case, it's going to be a capital cost of about $2 billion US to get to a 30-year mine life producing 35,000 tons a year of nickel and 2,000 tons a year of cobalt in a very nice high-grade concentrate. We have a joint venture partner as a 15% Mitsubishi Corp. And Mitsubishi Corp, giant Japanese company. But just to be clear, we're not dealing with the car company, although that's a different division of the same company. We're dealing with the largest commodities trader in Japan. They've got a raw materials division, and their raw materials division likes to get involved in mines at the development stage. They've done this successfully many times, and they help you to get it developed. So we are in the development phase.
Thank you. And Sam?
Yeah, so my name is Sam Ash. I'm the CEO of Bunker Hill Mining Company, and we're located in the Silver Valley in northern Idaho. And we're restarting the Bunker Hill mine. That's quite an iconic lead zinc silver mine in the United States, operated for 100 years and was instrumental through the Industrial Revolution and 2 world wars, right up through the Korean War as a strategic asset, supplying lead, zinc, and silver to the American economy. The mine was closed due to environmental and regulatory changes. The mine closed in 1980, and it became a Superfund site. And for the last 40 years, under the direction of the EPA, there has been a massive environmental remediation. 2017, that remediation was completed, and there was a consent decree reached which settled all of the historic environmental liability. And that's where Bunker Hill came into the story. What we see here is an asset that has the potential and will be for us a cornerstone asset of what we're building, which is a multi-asset base metal and with a precious component focused miner located in North America, providing critical metals to the low carbon energy transition to the North American economy. So the phase that we're in right now is we're in construction phase. We've over the last 3 years, we've developed a resource and acquired a processing facility from Tech Metals, the Ponderay mill, which was ideally suited for us. And we're at the stage now where we're fully funded for restart, and we're in the early stages of constructing the mine. We plan to be into production near the end of 2024. So right about a year from now, we'll be commissioning and coming online. And I think, one thing that's remarkable about Bunker Hill is the pace and the speed at which we've been able to accomplish that. And that's for a very unique set of circumstances that we think is somewhat a differentiator for this asset in this company. And that's the fact that it's a historic brownfield mine restart on a phenomenal mineral endowment. But key to that is the regulatory framework that we sit in, which is 100% private land, 100% patented mining claims. So we fall in the regulatory framework of the state of Idaho, which is a phenomenal. It's a phenomenal mining district from a regulatory perspective. Still incredibly high environmental standards, but differentiates itself from other regulatory jurisdictions where that regulatory process is based on the technical merits. So as long as we meet and exceed the technical and environmental standards, which we are doing, then that regulatory process is very much apolitical and advances on its technical merits, which really sets this project and sets our timeline apart from a lot of other mining stories that one might find out there.
Thank you, Sam and Mark, for the thorough introductions. And it's going to be nice because two different commodities, two very different phases of development. So let's get into it with these questions here. The first one I have for you is, in your view, what is the primary objective management should prioritize to enhance value at this specific stage your company is currently in? And Mark, we'll start with you.
Well, really, all you can do is keep advancing the project. We have a known resource. It's drilled off. We've got, at this point, 950 million tons of reserves. 1.5 billion tons of resource, another in the measured and indicated category, and another billion tons, a little more than a billion tons in the inferred category. So, we have enough tons. We just went through a major milestone of putting together a very detailed preliminary feasibility study. And so now the next phase is to launch the environmental assessment and to take the project to full feasibility. And it's always very challenging at this stage because it's not, it's not like you're drilling a glory hole and making a discovery and, all that sort of thing. It's really a grind. However, the reward is so large, and I think that's the key here. We've got a very, 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 very large deposit. We've got a good partner, and we're always looking for more money to take this further along, and that's what you do at this stage. You continue to advance the engineering. We're planning to submit a project description soon, which will initiate the formal environmental assessment process.
Thank you. And Sam?
I think, the stage that we're in, it's all about execution, right? So we're fully funded for restart. We're actively working on mine construction. We're putting in systems and processes. We're building our team, and we're actually building the mine. And at this stage, it's all about on time, on budget delivery. And that's what we're fully focused on here. It's very, very simple. We have our plan, and we need to execute on that plan and deliver it on time, deliver it on budget.
Thank you. Right to the chase. When investors choose a commodity and opt for a publicly listed vehicle, what valuation metrics should they take into account regarding these different stages of the mine's life cycle? Maybe we'll start with you this time, Sam.
I think when you're looking at a company that's in the stage where we are, where we're executing a mine build, I can tell you the way that we approached it as a company and what we feel is really important, and what we're looking to try and deliver and what we are delivering is a restart that happens as quickly as possible, and one that focuses on minimal capex and a quick generation of free cash flow. So I think when we looked at the opportunity that Bunker Hill presented, that's what we saw. So we see enormous upside potential and value creation potential and opportunity. But what we believe and what we're doing as a company and our strategy as a company is get to a position where you're generating free cash flow as quickly as possible, and then use that free cash flow generation and that cash flow to unlock additional upside value and growth opportunities, both in the asset and from a company perspective. So if you think about it almost like an engine, you start the engine by getting to free cash flow generation, and then that free cash flow allows you to accelerate and create a faster and steeper growth trajectory and value creation trajectory thereafter.
Thank you. And Mark, you released your PFS for the Turnagain project. A lot of numbers to put a value on this deposit. What valuation metrics should people consider and look at with a company like yours?
Well, it's the whole topic of valuation metrics when you're not actually in production and generating cash flow is a bit of a thorny subject. You can look at depreciated net present value at different discount rates, but I think basically there's at every stage, at the exploration stage, there's obvious risk. At the development stage, there's risk. At the construction stage, there's risk. And people, that are not sophisticated investors in this area, I think everybody's aware that mining is a risky business. So, in terms of valuation, what are you looking for here? You should be looking, in my view, and I am an investor in this business. I am an investor in junior mines personally. I've got quite a portfolio. You're looking for, at a minimum, 10 times your money. You're looking for a shot at 10 times your money, and that does come with risk. But you're looking for a minimum of 10 times your money, in my view. That's what I'm looking for when I invest in this sector. So, we've got a depreciated net present value in our base case scenario that's a little over $500 million US. Our market cap is $20 million. So, we're at the development stage, we're slogging along, but is there upside? Yeah, there's a ton of upside here. And the other thing I'd say about this whole sector and the idea of investing in it, and bear in mind, none of us here are investment advisors. None of us have licenses to advise on investment. We are, Sam and I are both promoters. We honestly believe that our projects are the best buy on the board. We're very biased. So, bear that in mind. But, I really think what you're looking for is the ability to get in cheap, and you have to have patience in this business. You don't know what the timing is going to be. You don't know what the spark is going to be that'll start, a stock moving. But if you can get in cheap enough, you can afford to wait.
Now, I'd be remiss if I didn't ask this question since you brought it up. Just a question for you, Mark. How long have you been speculating in the space, and what are you looking for these 10 baggers?
Oh God, I've been involved in this space since 1986. Hate to say it. Management. I mean, if you invest with the right management team, you might buy in because of one property, and then they can end up delivering a win on a completely different property. because they're generative and they find things to work on. So yeah, I look for management. I look for my opportunities mostly to get in cheap. Most of the money I've made in this business, they're stocks that I've held for 4, 5, 6 years before I'm able to extract a profit, and that's fine, because again, this sector gives you opportunities to get in cheap, and I think I don't think anyone would argue that we're at that point right now in the market cycle. It's unbelievable. Everybody, I look around, everybody goes, "This is the worst market I've ever seen." Well, I've heard that before. It's been the worst market anybody has ever seen before. But that's where we are right now. Everybody's very deflated. Everybody's stock is down. And so if you're from outside of this market, this is a pretty good entry point.
Anything to add to that, Sam?
I think as well, to add to that, I think that one thing to think about is mine life and how it relates to the all-in sustaining cost of production. And I think that when you look at commodities, there's going to be commodity cycles. So if you can find an opportunity that that has the potential for a very long mine life and a cost of production and all-in sustaining costs that is in the the bottom half, or even potentially the bottom quartile, you're looking at an asset that will survive the down points in the cycle, in the commodity cycle, but will make exceptional returns in the high parts of the cycle. So I think that there's often unrecognized value in some projects that have a long mine life, because what it doesn't recognize is that in a 20 or 30-year mine life, that mine, as long as it's able to stay profitable in the low turns of the commodity cycle, is going to have 3, 4, potentially 5 exceptional periods of return over that 20 or 30-year life.
Well,
Totally agree.
with this alluring 10-bagger potential in this industry, what about for the unsophisticated or the novice or new investors? Is there an area in this sandbox that's better to play in if you're new and interested in having exposure to this space?
Boy, that's a tough question. I don't think I can really answer that. Sam, I defer to you on this one.
Well, I mean, a couple of things come to mind. I think that I think one of the things to think about is the topic that we're talking about today, and it's, to a certain extent, it's a different investment thesis depending on the stage that a company is at or a project is at. So at the exploration stage, it's there's phenomenal value creation opportunity for a new discovery. There's also a phenomenal opportunity that that present themselves at a stage where a company is adding value through engineering and project development and advancement. And then there's another phase, through the construction phase, that a lot of value is created. And then, of course, exposure from just a pure commodity price perspective, where you would be looking, in my opinion, more towards proven producing companies. So I think a lot of it has to do with, what are you looking to invest in? Where it's a bit more speculative towards the exploration side and through the project development and construction phase, and it's a bit more you can tangible value perspective once you have a company that or an asset that is in production. So it's just a slightly different, and that's what's interesting about investing in the mining space is it offers kind of a wide array of investment focuses through the different periods of development and mine life cycle.
And all the stages are leveraged in one way or another. Like if you're a producing mine, it's like a pure exposure to the commodity price that you're producing, only it's levered by 3, 4, 5 times. So if the commodity goes up, typically the stocks of the producers go up far more than, in percentage terms than the commodity goes up. There's a real leverage to it. And again, you're looking for outsized returns. People have said, well, it's like buying a lottery ticket. That's not a good analogy, I don't think. I think a better analogy, if you're going to go to gambling as an analogy, it's more like poker playing. Sure, there's an element of luck to it, but there's also a lot of skill to it. And so, poker is a game of luck and skill. Some people make millions of dollars as poker players. Most people don't. So it's much more similar to that. There, if you know what you're looking at, you can make the odds work in your favor.
Great. Excellent answers, guys. Just referring back to your lever example, it works both ways, Mark, right? For upside and downside. So what about risk mitigation at your specific stage in your companies?
Risk mitigation, God, it depends how you look at it. Years and years ago, I used to be a broker in this space, and I would finance mining companies. And typically my risk mitigation would be, if we had some success and the stock tripled, maybe we'd sell half our position. We still believed there was upside. We still, liked it, but we would recover the capital, and then diversify our holdings. I personally don't do that so much anymore. Once I make a commitment to something, I'll stick with it for a long, long time and let it play out unless something happens that makes me go, wait a minute, I shouldn't be here anymore. So I don't tend to, recover my capital as much as I used to in the early days of this. Everyone's got a different investing style.
And Sam?
And I think from my perspective, I think from a risk mitigation and being an investor in the mining space, I think it's about diversification. But I would say it's diversification, across those different stages of a mine life and an asset. So, with a lot of the large major companies, some of that diversification is built in, because they always have projects that are at an exploration phase, often have projects at a development phase, a construction phase, and a foundation of producing assets. So that's to a certain extent with the larger mining companies, that diversification is built in. If you're looking to create that diversification yourself as an investor, then I think what's reasonable is to invest in exploration-focused companies that have high-quality exploration assets, development companies who have projects that have solid economics, and a solid plan towards moving to construction, and then in construction assets where there's you can see a track record of the project is progressing on time, it's progressing on budget, and we're getting very close to that free cash flow catalyst or milestone. And then on the producing side, there are companies out there that are smaller companies, and the focus of their company is being a solid low cost producer. And then on the producer side, you can look at mining companies that are have diversified metal portfolios, or you could look at companies who are more commodity focused and commodity consolidated. So it's diversification, and that's another great thing about the mining sector, is it offers enormous opportunities to diversify within the mining sector with companies that are at different stages, companies that are operating in different geopolitical environments, companies that are operating in different commodities.
And the mining sector itself is a diversification from all the other asset classes that you can invest in.
Sure, definitely. In terms of analyst coverage and reports, do either of you gentlemen put much weighting toward those?
I don't, and I'll tell you why. Most analysts, Bay Street and Wall Street and so forth, are geologists. So I care what they think about exploration properties, if they're good geologists. Not all geologists are good geologists. But when it comes to analyzing, technical documents like, pre-feasibility documents, feasibility reports and stuff like that, they're not mining engineers generally. And then the other part of it is that in general, they don't even analyze anything that their firm is not doing financings for. They're supposed to, but generally, and there are exceptions, but generally they go where the business is, and so they're not completely unbiased. For a geologist or a CFA or someone to go to, say, a feasibility report and go, okay, here's 2 projects, let's compare them. Well, here's the internal rate of return. Here's the depreciated net present value of project A. Here's the internal rate of return. Here's the depreciated net present value of project B. This one's higher. My due diligence is done. And, they don't, and generally, mostly, with some exceptions, have the capacity to look at how the sausage is made. Like, what are your assumptions around CapEx? What are your assumptions around sustaining capital? What are your marketing assumptions? All of these levers that you can pull, they matter. And so I think what matters more than analyst coverage is who's your partner. If you've got a partner, do you have a good partner? And because generally the people that are in the mining business, the big mining companies, the big trading houses, have expertise. They do know how to rip apart an engineering report and analyze the details of it. They can look at how the sausage is made. And, I think that's more important. And another element of this is that the analysts generally cater to the institutional market. And so if you've got a market cap in excess of $200 million, okay, they can look at you because, and even better is $1 billion market cap, because the institutions look at, do I have enough liquidity to get in and out with meaningful positions? And if you've got a market cap of 20 million or 10 million or 30 or 40 million, you're not going to get coverage because the institutions aren't interested because there's just not enough liquidity. So it's kind of a catch-22. Anyways, the short answer is I don't pay much attention to the analysts.
I think what I would say is, I agree with a lot of what you said, Mark, and I think that it's another data point, right? It can't be the only data point, and I tend to think that, as you said, Mark, the larger the mining company gets in terms of market cap, the more useful analyst reports and analyst coverage,
Right.
can be. If you're talking about a multinational, top 5, top 10, maybe even top 20 mining company, I think that the analyst coverage on companies like that is broad, well represented, and because of the nature of those businesses, is probably a more valid data point that you can put a little bit more weight in. I think the junior mining space is underserved by analysts, and because of the reasons that you articulated, Mark, just the nature of the smaller market caps, smaller companies, the fact that analysts are tied to financial institutions. So there's there the junior mining sector is somewhat underserved by the analysts, and therefore you have to go and dig a little bit deeper. And I do like your comment, when you said looking at who the strategic partners and that are associated with companies, because you're absolutely right. If you're looking at a junior company who has solid strategic partners, you can rest assured that they have those strategic partners because those strategic partners like what they see, and they have the technical expertise to do a deep dive, and so there's certainly something to be said for that, and that's a strong indicator in my view as well.
Yeah, it's interesting. And what you said about the junior market being underserved, another way to look at it is that creates opportunity. I mean, if you've got a big story and your market cap is $20 million, the analysts aren't going to look at you and the institutions aren't going to look at you. If you've got the same story at a $200 million market cap and you can show some upside beyond that, that's when they get involved. So they do the opposite of buying cheap. And that's what leaves the opportunity for individual investors to go, okay, well, I'm going to get in cheap and wait. We'll see what happens. Maybe the commodity market takes off. Maybe there's some event. Maybe somebody comes in, and if it gets to 10 times the market cap, well, the institutions are going to start buying it. Then it's a very odd ecosystem.
I like that statement. That makes a lot of sense. I have a question I wrote down here regarding financing options and tax incentives in Canada for exploration expenditures. I'm just wondering, can any of this be applied to financial studies, economic assessments, development, and construction costs?
Well, in Canada, there's flow-through funding available, and particularly for critical minerals, but it's really for exploration. It's not for development. The government is very interested in developing sort of battery supply chains and critical minerals. And so they are coming out with, there's a $1.5 billion fund in support of developing infrastructure around critical minerals development. That could be quite useful. We're in the process of applying for some of that right now because we've got a power line to build. We've got, road improvements to make. And, all of that is currently carried in our financial model as our expenditures, 100% equity. But if the government would take some of those significant infrastructure costs off our hands, that would make it much easier to go forward. It would also send a message to the international investment community that Canada is, it's not just talk. We are open for business. So,
And Sam, Bunker Hill's dual listed, operated in the States. Anything to add there?
Well, as a U.S. asset, we're not able to use flow through financing, and we're not able to utilize that mechanism. But there are mechanisms in the United States, and certainly with the more recent increase in focus on strategic supply chains and strategic in material sourcing, you're seeing some movement from the U.S. government. I mean, in the last 6 to 8 months, you've seen some, fairly sizable investments actually through different governmental departments. The Department of Defense comes to mind. The Department of Energy comes to mind, where the U.S. government is looking to make very targeted and important, from a scale perspective, investments in specific and targeted, critical metals that are related to a secure supply chain. So we're seeing movement, we're seeing increase in that, and we hope to see more of that.
I'm just going to go on a tangent here, Sam, but I know Bunker Hill has silver as well. Do you see silver ever being considered a critical metal in the States?
That's interesting. I think that I don't know if the U.S. will ever list silver as a critical metal. I personally think that it should. When you look at the supply-demand dynamics and around silver, I think it's clear that its importance as a low carbon energy transition metal is increasing and continues to increase. But it's hard to say whether it'll ever reach a critical metals designation. I tend to think it may be a while.
Thank you. I had a couple company-specific questions here I just wrote down. So I'll start with you, Mark, for this one. I wrote, the later half of this year, your team announced a very thorough PFS study. How did the market react to the study, and is it just justified?
Oh, the market barely reacted. I'm talking about, frankly, it's very hard to make headway in this market. But the other market, the market that you don't see, is reacting quite favorably. And what I'm talking about is potential strategic investors. We were 6 weeks ago, just after the PFS came out, we visited Tokyo and our partner Mitsubishi Corp. And again, their modus operandi is they want to end up with a minority interest in a mine. They want to end up with their pro rata share of the offtake, and they hope to end up with more than their pro rata share of the offtake. But they do not want to operate mines. So, and again, they've done this successfully many times. Helped to develop a project, helped to finance it.
So, Kyle, I can pick up more generally, not speaking to, a specific Bunker Hill pre-feasibility as a catalyst, but, what Mark said there, he made a pretty important point, is that the markets that you don't see are very active. So for example, strategic partners, whether that be a Mitsubishi, a Tech Metals, very active in supporting projects, and also you're seeing royalty and streaming companies are very active, and they're actually, from my perspective, they're filling a void that the capital markets, particularly the capital markets and the equity markets in Canada, used to fill, and is at least at the current time and over the last couple of years has been somewhat on the sidelines.
We've actually got another strategic market that hasn't been around before, but that is not active, well, somewhat active, but certainly very interested, and that is automobile manufacturers who are trying to transition to the electric vehicle business, and and they're worried about long-term supplies of both nickel and lithium primarily, and both nickel and lithium are down right now. But if you look 5 years out, 10 years out, it's going to be hard to get your hands on any. So they are seriously looking at getting involved upstream and upstream diversification. We are having conversations with some OEMs that have brought in-house the capacity to analyze mining projects. We're talking to some car companies that know they need to invest upstream, but they haven't brought in that capacity yet. Their thought process is evolving. But that's an interesting new source of strategic money that has not really gotten active yet, other than Ford. Ford got active with a laterite project in Indonesia. They're partnered with the Chinese on it. That's the only. Well, no, there's other moves as well. There's other sort of investments, more passive investments in lithium projects that I've seen and so forth. So that's, that whole market is extremely interested in what we're doing. And if we can close a deal with one of them, maybe that will provide some excitement for the, retail and institutional market in our stock. So we'll see.
Right. Thanks, Mark. Sam, I had a question regarding Bunker Hill here for you. Your team started construction post-COVID. Are there any issues with supply chains that you undergone? And in this high interest rate environment, did that affect your capital expenditure at all?
Interesting question. So certainly, in the depths of the COVID epidemic, there were supply chain challenges. Now, where we were at as a project in the depths of COVID, we were fortunate that we were at a stage where we were doing resource definition drilling, we were doing technical studies, so that was not too much of an impact. The other thing that was fortunate is that while we were in the COVID pandemic and supply chain we were disrupted, we were able to work with and gain a strategic partner and acquire the full processing facility. So the processing facility in the Bunker Hill restart is the largest single area of capital expenditure that we have by a long shot, over 50%. And the acquisition of a process plant that met our needs and was in good condition and relatively close, only 140 miles away, allowed us to mitigate some of the inflationary pressures coming out of COVID. So as we moved out of COVID and the supply chains were correcting, and you began to see the impact of inflation, the largest capital expenditure that we have at Bunker Hill had already been acquired, and the prices already essentially known and locked in. Now, it's not to say that we don't have inflationary pressures. We do, but to a large extent, we've been able to mitigate those. Another area that we have in our favor regarding inflation is just where we're located geographically. And we're quite fortunate. We're in the Pacific Northwest. The mine sits less than a mile from a major east-west interstate highway, Interstate 90. We're about an hour from the Spokane Valley, which has all of the light industrial service providers and talent that we would need. We're located in the Silver Valley, which is a historic mining district, which is still active with the Hecla operates the Lucky Friday mine. America's Gold and Silver operates the Corp complex. So we're in an area that has mining support services that are close at hand. And then we're also in an area where, because of historic government investments in infrastructure back in the 1930s and 40s, we're primarily hydro-based electricity. So we have very favorable energy price that is stable and low over a long period of time. So we're fortunate from that perspective that inflation hasn't been too much of an issue, and because of how our project development fell in relation to the COVID pandemic, it was a much more muted impact than it otherwise could have been.
Thank you, Sam. And that's all the questions I had. So for any individual that came in a little late, we did put some time aside for Q&A, and I do see some questions in the chat, so I'll address those, but please feel free to submit more questions if you have any. Mark, we do have one specific to Giga Metals. If Mitsubishi got 15% for $8 million of Hard Creek Metals, what percentage would a $50 million fetch to advance your project?
Well, what we're looking for is we're looking for $50 million US for 20% of the joint venture company. That's our ask, and that's what we're out there shopping right now. And it's I don't think anyone's really blanching at the price. It's all about due diligence at this point. So bear in mind Mitsubishi got involved at an earlier stage. We'd done a PEA, and we used their money to do the data acquisition on site, including drilling, metallurgical work, et cetera. We've done a lot of work to come up with a PFS. We have de-risked the project significantly. And so it's a different project. It's a much more advanced project than when Mitsubishi bought in. And I have to say they're very pleased with our project, with our progress.
Thank you. And Sam, I'll let you address this question from the audience first. Seems to me the best bang for your buck, or for the 10-bagger potential, is an exploration stage versus production stage, correct?
Not necessarily. Okay, so and I think that both Bunker Hill and Giga Metals are an example of that. So if you think about this, at Bunker Hill, we're sitting around a $30 million market cap, but you're looking at an asset that we believe, and the reason that we're here doing this is because it's going to be the cornerstone asset that is going to be the cash flow engine to create a multi-asset North American focused mining company over the near term, 3 to 5 years. Now, when you look at that value creation potential there's absolutely 10 bag, potentially more. So if you look at companies, and there's examples out here of companies who have been able to go on a similar trajectory, SSR Metals, SSR Mining, who eventually merged with Alicer. You're looking at companies that are going from the sub $100 million market caps to billion-dollar market caps over a very short amount of time. Maybe from a mining perspective, right? Over a 5 to 7 year period, maybe an 8-year period, where there's tremendous growth potential. Now, I would say on the exploration side, you can find opportunities where you have that 10-bagger, but sometimes it's just, the scale is a little bit different. So it's a little bit more risk. It's potentially a lot more risk. There's more uncertainty, but you can see spectacular value creation over a much shorter amount of time. But I think I would argue actually that the larger value creation potential actually exists in companies who have de-risked that growth potential through the careful, diligent work on the geology side with drilling, de-risking from a geological and a technical aspect their operations. So you have a much clearer idea of what the actual value potential can be. It's quite hard to determine what's the value potential sometimes of an exploration company because you have so much uncertainty around what is the geology actually going to be.
I totally agree with that. At the exploration stage, people say it's 1 in 1,000. I don't think that's quite true, but the odds are very long against making a significant discovery at the exploration stage. Once in a while it happens, and those are the ones we all remember. and it's very exciting. But I mean, before this chat, I looked up Bunker Hill Mining. I hadn't really dug in at all, and I looked at sort of the price performance over the last little while, and I tell you, that's exactly what I look for. Here's a stock that's been beat up that shouldn't be beat up. There's no real reason for it to be beat up, and that's where you get, I mean, it's you don't have geological risk anymore. With a company like Bunker Hill, you don't have development risk. We have development risk, but no geological risk. We know what we got here. Bunker Hill has execution risk, basically, is the way I would put it. Is that fair, Sam? So, an execution risk can bite you. It's a real risk. But it all depends on the management and their ability to manage execution risk. But I tell you, I just looking around right now, I'm seeing examples where, my God, it's quite a developed asset, and there is at least 10 bagger potential because of market conditions right now. So, and another question I get asked now, just by the way, if you're in the audience and you're new to this sector, I don't promote my company to my friends who are generally not in the mining business. But sometimes they'll come and ask me, and they'll say, "Well, that looks really interesting, Mark, and it's nickel, it's big, it's EVs, I'm thinking I might buy some. How much should I buy?" And I go, "Oh God, well, it's risky," and I'll say all that sort of thing. But at the end of the day, and again, this does not constitute financial advice. This is just a word to the wise. If you're new to the sector and you're willing to take on the risk because you're looking for that 10 bagger, how much should you invest? Well, my question to you is, how much would you spend on a really nice vacation for your family? For some people, that's $2,000. For some people, that's $30,000. It depends how rich you are. It depends how much free cash flow you've got. But that's probably an appropriate amount for someone to invest, in the mining business that isn't sophisticated about the mining business. Because if you lose 90% of your money, it means you're not going to go on vacation one year, and that's your downside. But if you get a 10 bagger or a 20 bagger, that can be a real nice addition to your finances.
I haven't heard that saying or that phrase before. I like that. The last question from the audience is from Louis or Lewis here. What financial and economic elements pose the greatest challenge to quantify when projecting bottom line results? And whoever wants to kick it off first.
I'm not sure. Can you? Sorry, Colin. I'm not sure I understood the question.
I'll read it again here. What financial and economic elements pose the greatest challenge to quantify when projecting bottom line results?
I'm going to pass that to Sam because I'm not sure I understand the question.
That's interesting. So if you're thinking about which ones are the hardest to quantify, I think the way I might answer this is that in pretty much any technical report that you read, there'll be a section that talks about the sensitivities. So, and that might be an appropriate way to think about that. So when I'm talking about sensitivities, you'll go to the economics chapter in any PEA, pre-feasibility or feasibility study, and there'll be a discussion and an analysis of the economic sensitivities, the sensitivity to metal price, the sensitivity to operating costs, the sensitivity to CapEx expenditure on the project. And everyone is slightly different. And I think that every project is slightly different. And I think that's a good place to start to understand maybe not which ones are the hardest to quantify, but which ones are the most critical. So if you come, for instance, if you come across a project where the sensitivity to metal price is highly sensitive, and a 5% move or a 10% move in the metal price drives either significant upside value or significant downside value, you're looking at an asset or a company where if you want to make an investment in there, then you would want to be of the view that the metal price is either stable or likely to increase. But understand that if your view is that there's downside metal sensitivity risk in your view, then that may not be what you're looking for.
And with that risk, Sam, comes opportunity.
That's right.
I mean, if you've got a project, and our project is very sensitive to the price of the underlying commodities, extremely sensitive. And if you've got a project that is very large and sensitive, again, it depends on your view of the underlying commodity. And, if you believe that nickel, for example, is essential to the development of the EV business, which I think it is, and it's fair, then over time, I mean, the growth rate in the use of that commodity is up. But bottom line is, if you think it has to go higher, then you're looking for those highly leveraged projects.
Yeah, that's right. And and another useful one is the capex and the opex, and every asset has has different sensitivities to capex, has different sensitivities to metal prices. Some are highly sensitive, some are less sensitive. Typically, one will stand out as I have this is the aspect or the area of this mine that provides the most leverage, and and there's two sides to that leverage story. You're absolutely right. There's the upside leverage, and the downside risk. And for me, when I look at it, I also couple that with the mine life, understanding that when a mine is in operation, particularly when you're talking about commodity price, you're going to see. I almost like that leverage because I know, looking at history, if you have a long mine life, there's going to be 3, 4, 5 periods of time where the returns on that asset are truly remarkable. So I think that's a good place to start, is in the economic analysis and commentary of technical reports, and looking at and understanding the sensitivities. And there will always be a discussion of that in every well-prepared technical report.
Thank you. We have one more question we can get to from the audience here. And since we're talking the sensitivity of commodity prices, Josh is wondering about if a move in copper, and this is more directed toward you, Mark, if a move in copper would affect the prices of both nickel and cobalt.
Well, I don't think a move in copper has a direct effect on nickel and cobalt. I think all base metals have a tendency to move together somewhat with regards to worldwide GDP growth. So nickel's part of or has traditionally been part of the steel complex. Its largest use is in making stainless steel. So like copper, if you've got robust economic growth, then demand for both commodities goes up at the same time due to the steel part of the business. What's changed, though, is nickel is very levered to the growth of the electric vehicle business. And so is copper to a lesser extent. Copper is very much needed for electric vehicles, charging stations, et cetera, et cetera. There's a whole growth component there, but it's not levered to the same extent as nickel. So, I don't think the one affects the other, but I think they're both subject to similar external effects.
Great, excellent. And thanks everyone that asked questions in the audience today. We have a couple minutes here, so I'm just gonna let you two finish off the conversation by just doing a little pitch here. Why don't both of you, 30 seconds, a highlight of 2023, 30 seconds, what to look forward to in 2024. And Sam, why don't you start?
Absolutely. So 2023, very exciting year for Bunker Hill. We achieved the milestone of full project financing, moved into the execution phase of building the Bunker Hill mine, and we'll be into production by the end of 2024. And really, what we're seeing is the first step towards what we're building as a company, which is a multi-asset base metal focused company with a precious component focused in North America and delivering metals to the low carbon energy transition that the world's going through. And I think I would say, just generally about, commodity prices, if you believe in the low carbon energy transition and that we will do that on a global scale, then there is literally no other way for metals prices to move than up. In a scenario where we go through a low carbon energy transition, there's an enormous gap between the supply and the demand side, which is going to require significant investment and significant growth in the metals industry. And it will be a phenomenal, once in a lifetime opportunity for value creation through investment.
That is so true, Sam. This whole energy transition theme is really just getting started. And I recall like 3-4 years ago, people that would project, how much EV growth there would be, how many cars would be sold. The ones that were considered crazy bullish 3 or 4 years ago were wrong because they were projecting, their projections were too low. It's happening. It's happening more quickly than anyone foresaw, and it's continuing to steam ahead. I just agree that this is a once in a generation opportunity to get involved in the metals markets. If you're new to these markets, I almost sort of envy you because you haven't been through all the pain of the last few years, and I think you're looking at an incredible entry point.
Thank you. And Mark, I want to give you the opportunity for you to highlight Giga Metals 2023 and 2024.
Well, the big event in 2023 was getting the pre-feasibility study done. That was a lot of work, and it was a significant de-risking, particularly in geometallurgy. I don't want to get too much in the weeds here, but our geometallurgical program is extremely successful. We've got very narrow error bars between when we predict how much we will recover from a particular part of the deposit, and then we do the test and we see how much we actually recover. The error bars are very narrow, and we did this over all sorts of parts of the deposit, different grades from high grade to what we know as waste rock, and our recovery algorithm just is remarkably accurate for a deposit of this type. 2024, it's all about finding that next partner. Mitsubishi doesn't want to build the mine. They don't want to operate the mine, but they're very, very helpful. So when we travel around with them to meet large companies that are looking at investing in nickel, we're starting our discussion at quite a high level of management. And that matters when you're dealing with extremely large companies as we are. The other part of it is dealing with extremely large companies. Nothing happens in a heartbeat. There is a very deliberate pace to the due diligence, and we know that. But we are making good progress with that. We're having some very interesting discussions, and we'll just have to see. Stay tuned.
Gentlemen, thank you so much for your time. My apologies if you're running late for another meeting here, but thank you everyone that attended. if you came in late, this is being recorded and will be available on YouTube probably within the day. So stay tuned. But thank you.